the refinancing of all the commercial real estate loans. It's putting tremendous stress on the banks, especially. And, the banks who, you look at Bank of America, it spent hundreds of billions of dollars on treasuries, short term. I don't know if they were 10-year. I think they were at under 1%. That, when the rates were down to zero, and now they've been eviscerated as rates have gone up to 4+%. They're down 10 times or more what they were worth. And it puts great strain on the system, because a well-capitalized bank, for example, according to the Basel III regulations, they have to have 4.5 cents on the dollar. During the pandemic, it was zero reserve requirement. So 4.5 cents on the dollar, if there's a run on the banks, which I believe there will be. After what we saw at First National Bank of Lindsay, Oklahoma, it's the first bail-in we've seen since the legislation was written, where half of the uninsured deposits are poof, they're gone. And when you see, I think, more bank issues as the overnight reverse repo market has been drained down and the BTFP program is over, this was the form of liquidity to these banks that has now been yanked. They have to sell their assets, which are 10-year treasuries, which are worth less than when they bought them. And that's what realized gains become or losses, instead of, the unrealized losses that the banks are drowning in. And so as rates go higher on the 10-year treasury, as they try and push down the front end, no one wants to hold our treasuries of any duration. I've said it. They're uninvestable when inflation is running much higher than they're telling us.
Did you know that silver, which has maintained a 90% correlation with gold throughout history, could be on the verge of an explosive price surge, potentially hitting $200 or even $7,500 per ounce? Andy Schectman connects the dots between suppressed silver markets, military-industrial demand, and the Fed's controversial rate cut policies. He explains how spiking 10-year Treasury rates, collapsing confidence in US bonds, and the hidden strain on banks are all creating a perfect storm. With banks already drowning in unrealized losses and systemic risks escalating, this could signal a breaking point for the US economy. Is the US Mint stockpiling silver for a military agenda? Are we closer to a financial collapse than we think?
He wants to bolster the military. So who knows what that truly means. I think he understands the significance. When he wants to bolster the military, you need to have silver. Maybe this is why the U.S. Mint for 4 years hardly produced any silver eagles, despite the demand. Maybe they've been stockpiling it. I don't know. But, you would hope that would be the case. I mean, you can't pretend to be have be the center of free trade and have markets that are being suppressed and manipulated. And now you have countries that are wise to it. So I don't know, to be honest with you. I think gold will probably be allowed to run much further, because I really do believe gold will be revalued. I think it will stand behind a new system, whether it be in the BRICS or in the West. Even the head of the IMF, who's big into the development of crypto, central bank digital currencies, Kristalina Georgieva, said, if a CBDC is not pegged to something, it's fiat. What other things can you peg it to? And I think they will let gold run. And silver and gold have a 90% correlation throughout all of history. They don't move in unison, but they often have a lag effect. I could see silver running to a level that most people would think is crazy. Maybe it's $75, $100, 200, who knows? But it's inelastic, meaning you only need a little bit for these items, these items like cell phones, like anything electronic or that conducts electricity needs a little bit of silver in it. Where it becomes a little murky is what does it mean for the military-industrial complex, and what's Trump's plan for the military-industrial complex? Because there's no question that you need silver to build high-tech weaponry. I've had this admitted to me by a consultant for the DoD, who I've talked to 2 or 3 times, once in Las Vegas and twice in Vancouver in person. And he confirmed that all of the high-tech weaponry has, at least in the cones of all of these missiles, has a lot of silver in it. And go to John Forrest Little's silverwars.org. He lays it out beautifully with fact, with support, in a chronological form that makes you say, It's interesting that you have 8 Western banks holding down the price, and you need massive amounts of silver for military equipment, and yet it's not accounted for in the supply demand numbers of the Silver Institute. What does that mean? Is this why you have the 8 banks short massively in London and the US? Yeah, I think it is. So, look, again, you can only manipulate a market for an extended period of time by pushing it in the direction it's going. No, none of these countries had the desire to accumulate this stuff. And just look what India is doing. There's no question that they get it. So I think it would be foolish to artificially suppress the paper price. It will only create strain and stress, but just I think they'd be better off by just printing more money and allowing a higher price for these metals, especially if they want to, if Trump wants to have any credibility for the US markets. You can't continue to do this when the rest of the world is wise to what we're doing. So I don't think it will. I don't think that he will allow the continuation of naked shorting to the degree that it is if he had his choice. But here again, these are very powerful people and they've been able to do it for a very long time. I don't know how it ultimately plays out, but all manipulations end, all of them, and usually pretty badly.
Can you explain for the less scholarly people why cutting of interest rates by the Fed is going to cause the economy to crash?
Well, because you have, some people call it bond vigilantes. They cut the federal funds rate, which is the overnight rate. It's the front end of the curve, the shortest duration, and they try to bring down the short duration treasuries. At the same time, the back end sells off because the back end, they're selling bonds. And as you buy bonds, as you buy them, then interest rates fall. As you sell them, interest rates go up. And what you're seeing are people selling 10-year treasuries, governments selling 10-year treasuries. They don't want to hold it because they believe inflation is only going to get worse the way that they're doing things. By lowering rates, this is a form of stimulus. It creates a weaker, less purchasing power for your currency. His policies are very inflationary, and the bond vigilantes or whoever it is saying, I'm not going to hold your 10-year treasury at this rate. We demand a much higher rate. And the 10-year treasuries, if you look at since they've decreased the front end of the curve by 75 basis points, 50 and 25, the 10-year treasury is up over 90 basis points. It's gone the other direction. And the 10-year is what all the banks hold. The 10-year is what the mortgages are based off of, what credit cards are based off of, the refinancing of all the commercial real estate loans. It's putting tremendous stress on the banks, especially. And, the banks you look at Bank of America, it spent hundreds of billions of dollars on treasuries, short term. I don't know if they were 10-year. I think they were at under 1%. That when the rates were down to zero, and now they've been eviscerated as rates have gone up to 4+%. They're down 10 times or more what they were worth. And it puts great strain on the system because a well-capitalized bank, for example, according to the Basel III regulations, they have to have 4.5 cents on the dollar. During the pandemic, it was zero reserve requirement. So 4.5 cents on the dollar, if there's a run on the banks, which I believe there will be. After what we saw at First National Bank of Lindsay, Oklahoma, it's the first bail-in we've seen since the legislation was written, where half of the uninsured deposits are poof, they're gone. And when you see, I think, more bank issues as the overnight reverse repo market has been drained down and the BTFP program is over, this was the form of liquidity to these banks that has now been yanked. They have to sell their assets, which are 10-year treasuries, which are worth less than when they bought them. And that's what realized gains become or losses instead of, the unrealized losses that the banks are drowning in. And so as rates go higher on the 10-year treasury, as they try and push down the front end, no one wants to hold our treasuries of any duration. I've said it. They're uninvestable when inflation is running much higher than they're telling us. John Williams says it's 11%, not the nonsense 3 that we're talking about. So if that's the case, why would you hold a 10-year treasury if you understood inflation is 3 times the yield? You wouldn't. And so that's what they're saying effectively is that we're going to sell bonds and push the back end up until you pay us more for holding any duration for all of the risk associated and the inflation. So the problem is that the entire economy really is based off of, or much of it, off the 10-year treasury, especially the banks. So as those rates go higher, remember what happened when the 10-year went to 5%, you started to see the banks blow up. Well, if all of a sudden no one wants to buy our treasuries anymore for these reasons and rates start to go up and up and up and up, you'll see banks collapse. You'll see commercial real estate explode. And that has a reverberation, and the systemic nature of the banks that are connected the way that they are very quickly can create a very scary event. So it's counterintuitive when you think, well, they're lowering rates, so isn't that good? Um, it's really not good. You're lowering rates when you're 65% away from your target rate at 2%. So you didn't beat inflation, you waved the white flag. You're lowering rates when stocks are at all-time highs, when cryptocurrencies are at all-time highs, when real estate is all-time highs. This is the same mistake that we've made forever, where you mess with Mother Nature, you mess with interest rates instead of letting the market dictate where they should be. The Fed does it, and it creates all of these distortions and misallocations and the price discovery in all of these assets where the price to earnings ratio is way out of whack and the prices are so high and only going higher. At some point, that is only going to get more difficult as rates move higher, let alone financing the debt, let alone all of the commercial real estate resetting. So it's a scary thing. And it's basically the market's way of saying you're trapped. Either you deal with these things and deal with austerity and reining things in and paying the piper, paying your bar tab, or you continue to do more of the same that all politicians do, and that is to choose inflation and suppression of interest rates over making the tough decisions. We can do it longer than most people or most countries because we're the world reserve currency, but we're at that point where we're struggling to meet our interest obligations, and that's when empires fall. We're very close to it. I mean, if by 2031, according to the Congressional Budget Office, which is a nonpartisan deal that all of the tax revenues go to just to pay the interest on the debt and the mandatory entitlements, which aren't even on the balance sheet, they're unfunded liabilities. So that's not even part of the 36 trillion. That's off balance sheet. 99 trillion shortfall in Medicare Part B, 22 in Part D, 77 in Social Security. How do you do that? Even with a balanced budget, even with trimming all of the fat of the government, you still got the same problem. And so as they continue to push down rates, which only blow up asset prices, create a weaker dollar and more inflation, people say, I'm not holding those 10-year treasuries. We demand much more. And you get to a point where it starts to break the economy. And we're not that far away from it, actually. So if there is a deep state and the deep state wants to mess with Trump, it would be with the banks. It would be with letting interest rates spike somehow and blow up the banking system and the systemic nature of it all with bail-in legislation that no one knows about is a very frightening thought experiment. So it's as crazy and doom and gloom as it sounds, it's really not that preposterous.
Now, you know how silver, gold, and the US economy are intertwined in this unfolding financial storm. But if you really want to understand the next big shift, you need to check out this video on why central banks are secretly hoarding gold and what it means for your investments. Click here to watch it now. And don't forget to like, comment, and subscribe to stay ahead of the game in today's volatile market.